The Fed has been raising rates since March 2022, and everyone expected a wave of bankruptcies and all of this distress. And it doesn't feel like that's happened.
Well, the earnings so far have held up. There was an initial issue with inflation that seems to have subsided, at least for now. But what's fascinating about this cycle is the catalyst today is not an earnings contraction. It's interest rates. This is very unique. So in 2000, when COVID hit, earnings contracted. It was a question of how long that would be. 2015, you had oil prices collapse. 2011, you had a European banking crisis. Interest rates rising as fast as they've ever risen affects all borrowers, right? 2/3 of the non-investment grade credit market is floating rate, so they're feeling it now. The rest is fixed coupon, but they're going to have to refinance that at some point. If you borrowed 3 years ago at 5%, you're not refinancing at 5%.
So you expect the wave of defaults to come?
Defaults are going to be much more protracted in nature. Okay, but when you put 6 turns, 7 turns, 8 turns of debt to EBITDA on businesses, and right now almost half the market is more than 7 times levered if you don't give companies credit for add backs to EBITDA. That just doesn't work in a 12, 13, 14% cost of debt market. If you just do the math, if you're 8 times levered and it costs you 12%, by the way, you couldn't refinance 8 turns today. Well, let's just say you could. And you could do it at 12%, which you can't do, but you could do. Just do the math. Like your EBITDA and your interest are equal. So your cash flow negative.
If you were to pick a year in terms of peak maturity wall, is it 25? Is it next year?
So the phenomenon we're dealing with now is going to help make this very protracted, which, by the way, is very good for distressed investors. Like we want to have stuff to do for the next 10 years, not the stuff to do for the next 1, 2, or 3 years, is most of the loan market is covenant light in nature. Okay? And what that means is that even companies that have broken balance sheets, too much leverage, cash flow negative, can actually borrow more debt, right? The answer to too much debt is not more debt, but without covenants, they can take additional debt and put it senior to the existing capital structure, which you can borrow, and that will prolong the inevitable. So I don't know when the peak default cycle will be. It will somewhat depend on what the economy does, but I do think this will be very protracted in nature.
But is the strategy then to bet on a wave of companies that do fold, right, crushed by debt, and you invest in the ones that survive and steal their share? Is it that simple?
No, I think that this is very early innings. So I think the nature of how we make money investing in distress will change over the next 3, 4, 5, 10 years. Right now, we're very focused on senior credit instruments. I would refer to it more as stressed than distressed. I think at this stage in the cycle, you want to focus on higher quality businesses, more economically resilient businesses. We haven't even had a recession yet. The companies that are in Chapter 11 today tend to be, there's exceptions, but tend to be lower quality businesses, businesses that not only have borrowing cost problems, but have operational issues. So we're focused more on stressed credit, senior debt in some of these over-leveraged LBOs. And you can get 15% doing that right now, which in our neck of the woods is pretty good for now.
You mentioned it wasn't industry specific this time, like we've seen before when it was energy a few years ago. But real estate feels like a particular focus for distress right now. Is that a part of your strategy?
We don't do a lot of real estate. We're mostly focused on corporate credit, so operating businesses. But the corporate credit, the commercial real estate market is a tsunami waiting to happen. I mean, there's something like $1.5 trillion of real estate related credit maturing in the next 3 years. So that's going to be an absolute disaster. If you look at office occupancy today, are just at 50%. People aren't going to renew those leases at anywhere close to the rates they were paying, 7, 10 years ago when all that debt was taken out.
Yeah, I wonder if that's a spark that triggers more problems in the market.
Yeah, I think it will be more real estate. I mean, the real issue for the earnings power of these businesses is the consumer. The consumer, and we saw the Q3 GDP print this morning. The consumer's been very resilient so far. Unemployment's still very low, but you have credit card debt, you have auto leases that are going to come due, you have mortgages that you took out at 2.5% 5 years ago with a 7-year IO that are going to need to get refinanced. So I think what we've seen is that the U.S. economy is a ship. It's a big ship, and it just takes time to turn. So you've seen rates move up very fast. That's affected the borrowing costs for these businesses today, but earnings power has been very resilient. I think it's just going to take longer to play out.
For it to filter into the household.
Yeah, I mean, the U.S. consumer is 2/3 of GDP, all right? So, as unemployment starts to move up, as people spend less and less on goods and services and more servicing the debt they took out in a zero-rate environment, I think you're going to see lower growth.